Hi everyone and welcome to the Skipton Insight podcast. My name is Olivia Charlesworth and today I'm joined by three of our in-house experts, Ben Smith, Catherine Hargrave and Kieran Ellis. Hello guys.
Hello.
Hi.
So this year has been a year like no other and a really challenging time for everyone. So in this edition we'd like to look ahead at what next year might bring. First, we're going to discuss the news surrounding a vaccine for COVID-19 and what that might mean for markets and the economy. And then we'll also be looking at what 2021 might bring for investors, both in terms of markets and potential tax changes. So let's start with the big vaccine news. US companies Moderna and Pfizer have both reported that they have had high success rates with their vaccine trials. Obviously, this is really welcome news for several reasons, but if I come to you first, Kieran, what impact did this news have on stock markets?
Well, broadly, markets have initially reacted extremely positive to the news of a vaccine. Global stock markets have had their best day since March, and currently they're back to their pre-pandemic highs even. Although markets have generally been growing since February and March, they have done so through very high levels of uncertainty around when normality could return, but also what reality could look like. This uncertainty has caused polarisation of sorts between different types of companies, those seen as the beneficiaries and those seen as old news, with the former having the lion's share of the outperformance over 2020 so far. But moving forward from here, as the accentuated gaps between said companies could even out, as the future becomes a bit more black and white, it provides the opportunity for markets to calm down and the polarisation between these companies to lessen, and with the investment funds alike through 2021.
And Catherine, what does all of that mean for customers who hold investments with us?
Yeah, our customers have seen ups and downs in the market and have been asking our advisors what to do during this period. So the phrase we use at Skipton is time in the markets, not timing the market, as it's the duration in the market which is important to help ride out these ups and downs. And this isn't the first time a world event has impacted markets. So, for example, when the Lehman Brothers collapsed in 2008, the market saw a drop of about 30%, which is quite similar to what we saw in March. And what history has shown us is that markets have always recovered from these significant falls. So what history has shown us is that markets have always recovered from these significant falls to date. And as Kieran just mentioned, we've already seen this recovery in the global equity market. So it's important for our customers to stay calm. Remember that these are only paper losses at the moment. And if you don't require your money at this time, then hold tight and remain invested.
Some good points there. So going into next year then, Kieran, what will a vaccine mean for markets?
Well, markets were expecting a vaccine to a certain extent. On two accounts, the announcement has, however, exceeded expectations. It's ahead of time, whilst leaving logistics aside. It means that by the end of 2021, we could be in full swing of a rollout of a vaccine, which is a lot earlier than what many expected. And secondly, the effectiveness of said vaccine is far higher than predicted and even higher than the seasonal flu vaccines. November may have also given us an insight into how markets will react to these conditions. We've seen what we call value companies such as oil and energy companies, travel companies, finance firms, for example. Those are all hardest hit by the lockdown and the restrictions, and now most likely to benefit from a return to a pre-pandemic type of world. And it's times like these that having a diversified portfolio shows its importance. When differing pockets of the market have their fortunes changed suddenly overnight, being positioned too far on either side of an argument can make it more difficult to achieve your long-term goals while the markets remain volatile.
Yeah, and we've seen record amounts of government spending this year to try and stem the economic impact of the coronavirus. Thinking about next year, Ben, what measures do you think we can expect to see to try and recoup some of this government spending?
It's no secret that government spending has been high in response to the coronavirus pandemic. There's a number of ways the government could recoup the cost of their spending. I'm looking at it on a simplistic basis. We could be looking at further borrowing, cutting spending, or by raising taxes. If we focus on raising taxes, as it probably has more impact from an investment point of view. The first thing that I thought of really was, interestingly, the Conservative manifesto in 2019 promised not to raise the three big taxes. So that was income tax, national insurance and VAT. In addition, it guaranteed not to change a triple lock on pensions. So it's unlikely, but not impossible, that we'll see these promises broken in light of the coronavirus, and only time will tell. In more recent news, and perhaps more realistic, we've seen the outcome of the Office of Tax Simplification paper around capital gains tax. And in there were some proposals, and there was similar again last year around inheritance tax from the same office. We also continue to hear rumblings around pensions and tax relief, and perhaps they're some of the areas that we may see changes in when we get to the next spring statement.
And what might a capital gains tax rise mean for investors?
The first thing really is to put into perspective that whilst it does look like there are changes on the horizon, it's important that we are still at a proposal stage. As I mentioned before, we've seen proposals from the Office of Tax Simplification previously, just last year, on inheritance tax, and as of yet, none of that has come to fruition. But when we look at the recent announcement on CGT, there were two key bits that stood out to me. The first one was that they felt there was a disparity between capital gains tax rates and income tax rates, and that was the main source of complexity. So we could see those rates effectively join up, which would see CGT move from, say, 10% for basic rate and 20% for higher rate to 20% for basic rate and 40% for higher rate, so effectively double. Additionally, the annual exempt amount was viewed as being relatively high at the current 12,300 allowance. There's other areas as well that were in the report, such as the uplift on death and the start value when you're assessing gains that and assets you've inherited. I won't go into that at this point, but again, we'll continue to assess that as well. I suppose the end outcome is that each of these proposals could increase the potential for investors paying capital gains tax, and we would encourage you to speak to a financial advisor if you have any concerns.
And Catherine, what should investors be considering when it comes to these potential tax changes?
So we would say don't change your investment plans off the back of the speculation. As Ben said, at this moment they are just proposals at this stage. So here at Skipton we'll continue to monitor the announcements and the impact on our customers, and we'll look to communicate that in due course. In the meantime, we'd always encourage our customers to make the most of existing unused allowances, considering their various tax benefits. So in particular, the ISA allowance, pension allowances, and as Ben mentioned, the capital gains allowance. So if anything, the potential changes to capital gains tax emphasises the importance of regularly maximising your annual allowance.
And Kieran, do you have a final few words on what course you imagine markets will take next year?
Well, in the immediate term, it is still going to be a difficult winter for many global economies. European countries, including the UK, are facing restrictions over the winter to help stem the spread of the virus until a vaccine can be rolled out. But also we need to cast our minds back to the possibility of a no-deal Brexit, which still weighs on the UK economy and clouds and uncertainty much of the future outlook. But looking further forward, much will depend on the timing of a successful rollout of the vaccine. The sooner that is, the sooner the recovery can begin. But the pandemic will leave some lasting damage, which will most likely take till beyond 2021 to fully recoup. There are significant potential drags in the economy, like low levels of inflation, high levels of unemployment, and like Ben was mentioning, a large overhang of government debt. These are all aspects that we've been well aware of, though, for many months now. That will come as no surprise, but the recent news of a vaccine has certainly shaved a great deal of time off the predictions of when the economy will return to pre-virus levels of output. So it seems that there's finally light at the end of the tunnel.
Yeah, I think that's a bit more of a positive note to end on as well. So we'll leave it there. Thanks to Ben, Catherine and Kieran for joining us. And thanks to our listeners also for joining us. If you have any feedback or questions, we'd love to hear from you. If you've got any queries, you can visit www.skipton.co.uk/financial-advice/support for more information or just to get in touch with us. For now, we hope you all stay safe over the coming months. Until next time.